Hello and welcome to the SCI video series to support the Accounting Foundations course. My name is Eric Andrews, and in this video we're going to be looking at the General Journal. Let's start by looking at the accounting cycle itself and where the journalizing process fits into this. In prior videos we looked at what were called T accounts, and this was a way for us to analyze and classify the business transactions. In this video we're going to talk about journalizing. This is the process where we actually take the information from those transactions and actually put them into our accounting system. So what is the journal? The General Journal is basically the diary of business activities. It's where we record the transactions in our accounting system. There are several different types of journals, but for this class we're only going to be looking at the General Journal. In Accounting 2, we'll take a look at 4 different specialized journals that we use for different activities. Here we record the transactions in chronological order. There can be more than one person who is entering information into the journals, and these are used to feed what is called our general ledger. We'll look at general ledgers in the next video. Now before we start looking at journal entries themselves, let's take a look back at the T accounts and take a look at how that information is going to be important as we move into the General Journal. Basically, when we looked at the first transaction under our Carolyn Wells Consulting Company, we saw that she had added $100,000 in cash to the business checking account, and we gave her then $100,000 in financial interest in her Carolyn Wells capital account. We noticed that the left side was used for the asset account, the debit side, and the right side of the capital account was increased with a credit. This is going to be important because when we make our entries into the General Journal, the rule is basically that the debit entry goes first. That means that the cash account is going to be the first entry in our journal, followed by the Carolyn Wells capital account. Let's take a look at how this would work. In the General Journal, we're going to enter the amount that is debited. That's cash. So that is the account we're going to enter first. Next, we're going to put the amount of money that was put into that account in the debit column. Next, we're going to enter the account to be credited, in this case, Carolyn Wells Capital, and we're going to then enter the amount, which is the $100,000, into the credit side of the journal. Now, this is the step that we'd use just to get the information into our system. Where we looked at the information prior in the T accounts, that was simply for us to analyze how the information would be laid out. The General Journal itself is where we actually record the information. And this includes everything from the date of the transaction all the way through to the account numbers. We'll see this more as we get into the transactions. So here is the first transaction that we have here, the Carolyn Wells capital account. The transaction itself is in there, but what we need now is what is called a memo. This is a note that we're going to place at the bottom of the entry that gives us information about the actual transaction. We want this to be as detailed as necessary so that we can follow the information, if necessary, back to the source documents. A lot of times what you're going to see here are things like check numbers for expenses that we wrote a check for, or invoice numbers for bills that we received from our creditors. The guiding principle here is short but descriptive, and you want to make sure that you include any of the necessary information about the documents so that we can follow what's called an audit trail and find our way back to where an error might have occurred. So here's that first transaction again with Carolyn Wells Consulting, where the cash was entered into the checking account. So we debited the cash account, and then we gave representation of that financial interest by putting $100,000 into Carolyn Wells Capital. The memo for this transaction was investment by owner. Next, we're going to purchase equipment, and this time we're going to pay cash for it. Since we're increasing the balance of the asset account equipment, and that is done with a debit entry, the debit entry is going to go first. So we have equipment for $5,000 as a debit, And then cash, which we're decreasing the balance of an asset account with a credit entry, is going to be the second entry. In this case, the memo is going to clarify that we purchased equipment and that we used check number 1001 to do that. All right, our next transaction, November 10th, the Wells Consulting Services purchased equipment, but this time they purchased it on account, meaning we're going to have a liability involved. So we have a $6,000 debit to the equipment account, and then this time we have a $6,000 credit to our accounts payable account. We have a creditor who has extended credit to us and allowed us to buy this on account, and we're going to now put in the details in the memo about who we purchased that from, what invoice they gave us, and when the information or when the payment is due. In the next transaction, we purchased supplies for $1,500, and we're going to enter the debit entry for supplies, a credit entry to decrease the balance of cash, and then a memo that says purchase supplies using check number 1002. This lets us track back to the specific check if there was ever an issue. In our next transaction, Carolyn Wells Consulting paid Office Plus $2,500 as partial payment for the invoice that we used earlier to purchase the equipment. So, in this case, we're going to debit accounts payable, which remember is a liability account. The liability accounts, as a general rule, increase their balance with credits and decrease their balance with debits. Since we're making a payment, we're going to decrease the balance of the accounts payable account since we no longer owe that money. At the same time, we're going to decrease the balance of our cash account with a credit entry, and the memo that we have there was letting us know that we paid on a particular invoice using check number 1003. If you're having a little bit of trouble keeping up with the debits and credits, remember to pull out that T account chart that you can find in Moodle. This will help you understand why we're increasing a balance in one account or decreasing a balance in another account with a debit or with a credit. Next, Carolyn Wells Consulting Services wrote check number 1004 for $8,000 to prepay rent. So prepaid rent, again, is an asset account because they owe us that rent. We've paid them and they owe us the time in the building, so it's of value to us. So we're going to increase the prepaid rent account with a debit entry of $8,000, and then we're going to decrease our cash account by $8,000 since we actually wrote check number 1004 to pay that rent. In the next transaction, we're going out and doing some work. We've performed services and earned $36,000. We were paid in cash for this particular transaction. So in this case, we're going to increase the balance of our asset account cash by $36,000. Since it's an asset account, we increase that with a debit entry of $36,000. At the same time, we have to record the money coming into the company as revenue. We do this with an account called fees income. Since it is a revenue account, the balance is increased with a credit entry. So we enter $36,000 on the credit side for fees income, and we put in a memo to let us know that we've performed services and we're paid cash for those. In the next scenario, we're going to do work again, but this time we're going to extend credit to our customers and allow them to put that bill on their account. So we're going to use an account called accounts receivable. This is the account where we keep track of the money that people owe us. This is what we're expecting to be paid in the future. So we're going to receive that money later, hence why we call it accounts receivable. So in this case, we're going to increase the balance of that account by $11,000. This is an asset account, so we increase that with debits. And if you're wondering why is it an asset, well, we're expecting to get paid that money at some point, usually between 30 and 60 days. So that is going to be of value to the company, and that is why it's an asset account. At the same time, we need to record the revenue that we generated by doing that work. And so we're going to increase the balance of the revenue account fees income by $11,000. And our memo just lets us know that we performed services, and this time we did it on credit. Now, once the future arrives, we're going to receive payment from our credit customers. And so we are going to receive $6,000 in cash from our client. So we increase the balance of our cash account by $6,000. And at this time, we're also going to decrease the balance of our accounts receivable account because they no longer owe us that money. We record in there that we received the cash from that credit customer. Now we'll look at some expenses. Expense accounts, if you remember from looking at our T accounts, are set up in the opposite way of revenue accounts. So the debit entries are what increase the balance of expense accounts. And so this time we had a salaries expense of $8,000, so we're going to increase that balance with a debit entry. And at the same time, we're going to decrease the balance of our cash account by the same amount. And we'll use a memo to explain who we paid these to and using what check numbers. Next, we're going to pay another bill, our utility bill. So we're going to increase the balance of that account by $650 and decrease the balance of our cash account by $650. We'll make a memo letting us know what check we used. Finally, the owner is going to withdraw some money for personal use. So we're going to decrease the balance of her equity side by taking $5,000 out of the company. We do this with what is called the drawing account. The drawing account is set up with an opposite balance system than the capital account. So instead of increasing with a credit, the drawing account increases with a debit. At the same time, we're going to decrease the balance of our cash account since they're actually taking the money out of the company. And there we're going to record a $5,000 credit entry. In the memo, we just simply add that the owner withdrew cash for personal expenses and that we use check 1008 to do that. So that is the basics of the general journal itself. Thank you for watching, and I look forward to seeing you in the next video.